This episode is brought to you by Newline by Fifth Third. Drive your fintech forward with the embedded finance platform designed for enterprise fintech and backed by a leading financial institution. Discover how Newline can transform your business at newline53.com. Hello, and welcome to the Fintech Takes podcast. I have a very special episode for you today. I was delighted to be joined once again by someone who is kind of becoming the unofficial stablecoin correspondent here at the Fintech Takes podcast, James Wester, analyst at Javelin. And you might remember a previous episode a few months ago when James came on and talked about the role that stablecoins could play for domestic payments use cases. Well, fast forward from that conversation, obviously a lot has happened on the stablecoin front, including legislation creating a regulatory framework for stablecoins being right on the 1 yard line, just about to pass. And so wanted to have James back on to talk about a bunch of different stablecoin topics. Before we get there, though, one thing I wanted to mention and plug is the first ever in-person Fintech Takes event, which is going to be held the second week of November this year in Bozeman, Montana, and it's called the Fintech Takes Builders Summit. The focus is to bring together operators with great speakers who we're lining up. We're going to talk a little bit about the future of fintech and the big problems that need to be solved over the next 5 to 10 years. It's going to be very, very small scale. It's invite only, but if you would like to have your name on the list to get in for more information and to potentially raise your hand as an attendee or a speaker or a sponsor, we have shared a waitlist link through the newsletter. So watch out for that and watch out for more information coming soon on the Fintech Takes Builders Summit. And now, without further ado, here is James Wester. James Wester, welcome back to the podcast.
Thanks for having me back.
Oh, I am delighted to have you back. Stablecoins, we were joking before we hopped on, like, this thing is happening, so your time of, like, I feel like wandering in the wilderness, finding crypto interesting and trying to get other people interested in it. In some senses, it's coming to an end, and that creates good opportunities, but it also, as we were also joking about before we recorded, creates some sort of opportunities to get into circular arguments with people on Twitter. So I thought we would cut through some of the circular talking past each other arguments on Twitter, have you come back on. The last time you were on the podcast, we had a very narrow and specific thing I wanted to talk about, which was use cases for stablecoins in a domestic payments frame. That was a great conversation. Folks should go back and listen to that if you haven't already. This time, I want to hop around a few different topics because a bunch of different stuff has been coming up around stablecoins, the impact that they're going to have on the ecosystem. Obviously, we're like right on the precipice of having legislation passed, which I noted this in my newsletter. This is the first time in quite a while that we've had like a major structural, like new financial services legislation that will lead to new regulatory frameworks. And it might be the first big one in my lifetime that isn't following immediately on the heels of a like acute financial crisis. So it's kind of a cool moment to sort of think about what's happening in the space, what the impact is going to be on other players in the space, and just sort of like how stablecoins will shake up this ecosystem. So, James, I'm going to run through a few different areas. The first one I wanted to talk about is community banks, because I know this is an area you've spent some time thinking about. I actually wrote a piece sort of making the case for why stablecoins are not probably going to be great for community banks as a category. That piece came out actually really well timed with the Independent Community Bankers Association, ICBA, which is the main lobby for community banks in the US, also coming out publicly with some, I would say, strongly worded concerns about the Genius Act and about regulated stablecoins. So I'll put the question to you. First, do you think that stablecoins are going to be a net good thing or net bad thing for community banks? And then part two of that question is, and I already know the answer to this, would you like to put your answer in a broader context of what it means to be a community bank these days?
Do I think it is going to be good or bad? Honestly, I understand the concern that the ICBA is going to have. That makes sense to me. The broader context, so I guess the answer is, I think net, it is a challenge. But I think it is, in the broader context, a challenge that goes with lots and lots of challenges that members of the ICBA have been facing for a very, very long time. Mm-hmm. And part of the problem is that it illustrates where some of the things they have done in the past, or some of the things that we think have been done in the past to support banks, maybe weren't that great for them. So if you think about what's happening in terms of regulation, the last 4 years, there's been a regulatory environment that basically said banks stay away from crypto, stay away from even investing in investigating, stay far away from this. Maybe there was an opportunity for banks to look at these things in the past and say, hey, we're seeing deposit flight. We're seeing big banks benefiting at our expense. Are there things that maybe we can be exploring, like, and I'm not going to say that you would want to necessarily have a buy, sell, hold tool on your community bank app, but was there some way for them to have gotten involved and say, hey, stablecoins, holding crypto, something like that, can we at least investigate it? Absolutely not, said the regulators. Stay far away from it. It's bad, bad, bad. Then you also have a lot of these banks are serviced by a set of traditional legacy technology players, who have also not been very forward in terms of investigating or building in ways for financial institutions to look at things like distributed ledger, crypto, tokenization, stablecoins, anything like that. Mm-hmm. So basically what you've got is these banks that are already dealing with deposit flight, already having to deal with that. And it doesn't seem to me that they're being well served by the regulators that are supposedly protecting them. They're saying you can only do this very narrow set of things that are already sort of in jeopardy. And technology providers who are basically saying, there's a kid's book. I can't remember the name of it. I remember reading it to my kids, but the line was, you get what you get and you won't be upset. That's kind of what they're telling them. You get what you get and you can't be upset about whether it's core banking, payment processing, innovation, roadmap towards potentially integrating stablecoins, crypto, any of that into it. They basically have been sort of protected. And I don't think that it has served them well, as we now are beginning to see not just stablecoins, but things like open banking, as we begin to see consumers basically looking at their financial accounts, looking at payments and saying, do I need sort of this traditional bank? So do I think it's going to be good for them? Do I think it's going to be a challenge? Yeah, it's probably a challenge, but it's a whole lot of challenges that they're facing right now. And the problem is we keep retreating away from any possible solution that would allow them to be a part of stablecoins or, anything like that. So like when we talked about those retail use cases, we were talking about what are the retail use cases. And we were thinking about things like loyalty points or Disney or Starbucks or anything like that. Wouldn't it be great if a community bank could somehow participate in that, so that when you look at your application, you look at that banking app and you see where you maybe have a vacation account that has stable coins that are for, a cruise line or Disney or something like that. That's just not something that is on the roadmap for a lot of the technology vendors that are helping small banks. So that's the part where we seem to exclude them from anything that might help them out. So I think it's a good faith argument on their part, but I do think that it misplaces the blame on the innovation and not on the things that maybe they could, the innovation of stablecoins, and not on some of the things that have really held them back.
Yeah, no, I think that's totally fair. I mean, I think the broader point is it's really hard to be a community bank. Yeah. There's anytime you say, hey, this thing in banking is changing. Well, for the group of banks that really struggle to just continue to exist and sort of thrive on their own, that new thing is probably always going to be more of a net negative than a net positive, right? That's just the nature of being kind of the runt of the litter, so to speak. And so I think that is a very fair point. And you're right, like faster payments, open banking, name your sort of innovation. Doesn't have to be related to crypto or decentralized finance. Any of those things are ones where you see leading banks, large banks sort of leading on it, and small community banks kind of bringing up the rear, maybe not embracing it the way that, maybe they should be. And, it's also a function, as you say, of the core providers. I don't know of any community bank that likes their core, right? Like none of them do. They all are like, oh my God, like don't even get me started. But they don't really have a choice, because unlike JP Morgan Chase, that I think said they were going to spend $18 billion on tech in 2025, community banks don't have those kind of resources. They have to rely on vendors that serve community banks and that they can work with, and that naturally will limit their option. The example, James, that I want to bounce back to you that I think is kind of an interesting like precursor in some ways to this whole thing is it does sort of remind me a little bit of banking as a service, because banking as a service was sort of two different things melded together, right? One was there actually was a regulatory carve out unintentionally that gave community banks kind of what I would call an artificial right to win in banking as a service, which is the Durbin Amendment, right? And the exemption for community banks. And if the Durbin Amendment doesn't happen, I really don't think that you see a lot of community banks doing banking as a service, right? Like there just wouldn't have been like a obvious right to win. Why would you pick, Evolve Bank or, Coastal Community Bank or Tab Bank or whomever? Why would you work with them than you'd work with a larger bank? You probably wouldn't, but the Durbin Amendment sort of gave them a leg up with that debit exempt interchange. However, I would say the other side, and this goes to your point about regulators and policymakers, is I do think the other benefit that community banks brought to banking as a service, and I say benefit somewhat with air quotes around it because it did cause some problems as well, but community banks were willing to take risks doing banking as a service and partnering with fintech companies that larger banks weren't willing to. And I think to your point about regulators sort of sending a message across the whole ecosystem that we want you to stay far away from crypto, they sort of robbed community banks of the opportunity to say, hey, we are willing to be a little more risk on. We are willing to take on a little bit more risk to experiment with this technology or to work with players in this space that maybe our bigger peers who have more to lose might not be as willing to do. And I do think that was an element to community bank success in banking as a service. Now, again, it did create some bad externalities that happened eventually too, but you could argue that that's kind of the natural cycle of the ecosystem. And to your point about regulators, I think the biggest problem that bank regulators have had over the last not just 4 years, but even going back further, really since the great financial crisis, is regulators need to be okay with banks failing. It's okay for banks to fail. Like that's kind of one of the points of them, right? And like if you keep them away from every single little thing that could hurt them, it kind of reminds me of like raising kids, where it's like, I don't like to see my kids scrape their knee or fall off their bike or whatever bad things happen to them. But I'm not really doing my job if I don't allow them to take any risks. And I've seen that sort of overly paternalistic attitude from regulators. And I think banking as a service was kind of the exception that sort of shows what that looks like if you don't have that attitude. Does that make sense at all?
It does. It does. And I think that's actually a really fascinating way to look at it. And I do think also when you look at how we want to treat innovation, if we are going to start treating innovation as something that, yes, it's potentially systemically bad, it's awful, we can't let anybody touch it, as opposed to saying, well, you know what? We don't want any bank to fail. But if we are going to start looking at innovation, we're going to start looking at ways to bring new types of financial services, financial products, technology, access, any of those to customers. Wouldn't it be better if we're actually bringing it to a smaller institution where if there is a problem, if they do fail, it is not a systemic threat. You know what I mean? It's going to be, hey, this is the exact place we should be doing that. We should be allowing smaller banks that want to do something that's a little bit, like you said, a little more possibly riskier or new, something like that, innovative, that we allow them to do that. I think that's a good way to treat it. And I do think that we've treated it the exact opposite.
Yeah, no, I think that's a completely fair critique. And something, honestly, that I think we're still dealing with even under the Trump administration, right? I mean, prudential regulators are prudential regulators for a reason. Like they're all about safety and soundness. And so there is this line between innovation and safety and soundness. The other sort of structural component that ties to community banks that I wanted to ask you about, and I've raised this a few times and I've never gotten a totally satisfying answer from my perspective, is the deposit flight issue, right? I think it is reasonable to be afraid of stablecoins if you're a community bank, solely from the perspective of this will create another place for people to keep their money. That reserve that they're keeping their money might be denominated in treasuries. It might be denominated in deposits, but if it's denominated in deposits, they're probably going to be deposits with systemically important financial institutions, very, very large banks that do a lot of like custody and kind of global trade type work already. It's unlikely that community banks, I would say, are going to be sort of a net recipient of more deposits due to stablecoins, right? So not that it's going to cause like a massive flight of all deposits out of community banks, but it'll probably accelerate a trend that we've seen, which is deposits kind of flowing out of community banks. The thing I wanted to ask you about, and this kind of ties to this idea of like, we are passing legislation to create a new regulatory framework that is going to alter sort of the larger regulatory bank landscape that we have, is I do believe, and ICBA has certainly made this argument, and I think there's some merit to it, that community banks do a type of lending that is socially useful and sort of difficult to replicate through fintech or through big banks or through specialty lenders, like especially in the US that has a lot of rural communities, a lot of sort of otherwise what would be considered banking deserts, that lending money into certain places, a lot of small business lending, a lot of lending into underserved communities, that is sort of a unique function that community banks play. And, to be candid, every time I've raised this, I kind of gotten a little poo-pooed by stablecoin advocates who are sort of just like, oh, I'm sure we'll figure that out, or someone will pick that up, or maybe private credit will step in and do this. What's your sort of take on the sort of downstream implications of accelerated deposit flight or sort of moving money around in the system?
Oh, we'll figure it out. No, I'm kidding. I think, well, a couple of things. First, I agree with that. I do think that community banks do play a unique role. You will find few people who are as big a fan of community banks, family of small business people who needed banks for credit. Uncle was president of Madison County Bank in Madisonville, Texas. So I think that there is a lot to them. Where I think that we may have some misplaced concerns, though, is I don't know that the money that's going to go into a stablecoin is necessarily the money that would have gone into Madison County Bank or First City National of Springfield, Missouri, or something like that. I think that we continue to see stablecoins as this technology layer that is going to do all of these things. And oh, by the way, it's also going to take this money from those depository institutions in small counties or small communities or stuff like that. I am not certain that is where that money is going to come from. To me, I think it is probably going to be more like the money that a person would want to put into, not necessarily a savings account, but something like a CD or something like, basically different lines of business. That's what a stablecoin is going to be. Just like we're going to have, basically financial institutions, financial services are split along these different lines of business. I think that's the same way that stablecoins are going to be. It's money that is not necessarily something that I'm going to use for payments all the time. It is something that if I am going to go buy a stablecoin, I'm going to keep it there for yield. It's not something that I'm taking away from that account where I pay my bills that a financial institution, especially a small financial institution, is going to use for loans. I just don't think that's the way that it's going to be, that it's going to evolve. I do think that there will probably be something on the margins where, yes, some of that money is going to go away from that. Is it going to be a huge amount? I don't think so. I think that stable coins themselves are going to have their use cases, especially for things like, commercial payments or cross-border. We're already seeing that. If those types of use cases that we were talking about the last time we spoke in terms of retail or consumer business cases, I think those will be very specific, and it wouldn't have been something that I would have put that money into a bank. So I think we keep defaulting back to a stable coin is going to represent, a DDA somehow. I don't think that's going to be the case. Again, not saying that it's not going to be one more challenge that ICBA members are going to have to deal with. Those community banks are facing all sorts of things, but I just don't think that it is the systemic threat that they see it as.
No, I think that's fair. I mean, I think again, like deposit flight is a thing that already has been happening.
Yeah.
And this might just be one more thing. I mean, like shit, like money market funds introduced in the 70s created deposit flight, right? It didn't destroy all community banks. And so I don't think it's necessarily one or the other. I also think that to your point, the competition that stablecoins will create, it might actually be with money market funds, right? Or with money that would
That to me,
otherwise be
actually,
held in a
that's a perfect
GSIB.
example. That to me
Mhm.
sounds more like, because that's kind of what they really are. I
Sure,
mean,
sure.
it is a type of money. It is a money market. You are going to put your money in a stable coin, and it's probably going to be a stable coin that's going to offer you a certain type of yield. And that yield will probably reflect something like, risk or utility, where you can access it, how often you can use it, where it can be used. All of that stuff is going to be wrapped up in the product itself. So to me, it sounds more like that's what it's going to be like, is something like a money market fund.
Yeah, no, that makes sense to me. The other, I guess, angle of competition on this community bank side, and I'm curious for your take on this, tying back to what I was talking about with banking as a service. I kind of wonder if stablecoins might end up being infrastructure that's used by fintech founders of the future to build on top of. And the reason I'm thinking about this, and I maybe I'm skating a little too far ahead here, but Stripe is the company that comes to mind,
Yep.
right? They're all in on stablecoins right now. And the use cases they're focused on at the moment are like, hey, helping consumers in Latin American countries, buy stuff and keep money in stablecoins to avoid sort of unstable currencies in their home countries. But knowing fintech founders, especially like young early stage founders, they tend to sort of try to gravitate to infrastructure that's cool and infrastructure that will sort of throw up the minimum number of annoyances or barriers to get in their way of building whatever the thing is they want to build, right? And so as I've been thinking about it, again, tying back to what I was saying earlier about banking as a service, I don't think anybody wanted to build on top of community banks, right? Like there was no like 22-year-old who was like, you know what I'd like to do? I'd like to explain what I'm building to a, 60-year-old community bank CEO who doesn't even bank on their phone and try to convince them to give me an omnibus account at their bank so that I can bring on a whole bunch of customers who probably individually won't be profitable and will create a whole bunch of compliance headaches for them. Like, I don't think any 22-year-old was thinking that way. It was kind of just the only option for building a banking type thing using the infrastructure that was available. And in fact, the reason that Synapse became really popular, or Treasury Prime or Unit or Bond or any of those middleware platforms, is they abstracted away the pain
Yep.
of building on top of a community bank so you could build it without having to talk to that community bank directly. The reason I bring all that up is if I'm a 22-year-old and Stripe says to me, hey, how about we give you the infrastructure to build whatever banking thing you want to build that can store funds, that can facilitate payments, that maybe can offer yield, whatever the different kind of capabilities are. But you don't have to deal with one of these weird middleware platforms. You certainly don't have to deal with a bank. You can just deal with us, and it's all just native to the internet, programmable by default, global by default, instant, always on by default. That would seem like a fairly compelling pitch and a pretty competitive alternative to what we would consider traditional banking as a service. What do you think about that? Looking to grow your fintech with scalable API-enabled payments? Newline by Fifth Third empowers enterprise companies to accept and process payments seamlessly. Effortlessly launch and scale payment, card, and deposit products directly with Fifth Third Bank. Learn more at newline53.com.
I think you've hit the nail on the head. And I think you've hit the one area where when we do have all of these discussions about, is stablecoin going to be, is it going to contribute to deposit flight? And we talk about it as basically as a money substitute.
Yeah.
We don't hit on the programmability part of it, the smart part of it, the part that says it's not just $1. And I see that all the time. Oh, we already had this. We didn't. We didn't have money that does the thinking on its own, that you can basically program in all sorts of instructions to it, and it can go do all sorts of fun stuff. What can it do? Well, it can do things that treasurers really love. It can move at the last possible moment. It can basically eliminate things like escrow. You don't have to tie money up while you wait for things to happen. It does a lot of stuff. And that's the part where what you're talking about, I think, is the really exciting part of what makes stablecoins different. And yes, it's that being able to build on top of it that I think really matters. And I think it's that being able to build on top of it that is going to separate the stablecoin providers, the stablecoin ecosystems, and Stripe, I think, is the obvious, perfect one. That if you really understand what they've been able to do, and I shouldn't say it's obvious, actually, I'll take that back. That I think is a really, really good observation. And I don't think it's that obvious once you move outside of, banking and financial services, but looking at what Stripe has been able to do from a developer community, how well they have built that. Now you put that on top of a stablecoin infrastructure so that you do make it easy to build all of that stuff with that programmable money and do all of the things that you want, because it's going to be the developers themselves that say, hey, this is something I can build on top of, and I can do all this really cool stuff, things that weren't even possible before because we didn't have money that was really native to the internet. We had to have all of these other third parties involved to make this happen. We can do this now. That's where I think a company like Stripe is going to do really, really well. There are others that might be stablecoin providers who have reach. They have a lot of stablecoins in the market, but they don't necessarily have that developer community built. They don't have all of those bodies basically saying, hey, I want to use these stablecoins for really cool things. I think you're absolutely right. That is the part I think that's the most exciting, not the, we have stablecoins. And once we get the infrastructure in place, once we do figure that out, and we have the rules of the road and how they need to be either backed one-to-one with reserves, and how do we deal with the potential of a bankruptcy, and what do we do in terms of, where in line you stand in case there is that bankruptcy, all of that stuff, even what regulators pay attention to it, how we get all these turf battles worked out. Once we have that, it's that ability to then build on top of them. That's the part that's really exciting.
Yeah, I think that's exactly right. And I think, and this kind of segues us into some of the other things I wanted to talk about, but I think the regulatory part of it is really important, right? Because to me, if you're a sufficiently sort of responsible builder in the space, developer in this space, you want the thing you're building, if it touches money, to sit on something that people will trust, right? And when stablecoins and crypto are sort of outside the regulatory perimeter, there was some activity, there was some development. A lot of it was just for the on-chain economy, sort of speaking to itself. But if you were trying to get beyond the crypto economy to kind of the broader economy, it was hard for people to say, yeah, it's better to build on a stablecoin than it is to build on a bank, because that just didn't make any sense. But with the Genius Act and with the legislation that's coming, we are going to have, and this is how I've been talking about it, we're going to have a new category of regulated bank type thing, right? A stablecoin issuer. And there are going to be sort of very defined limits on what they're allowed to do, how we guarantee the safety of a stablecoin. We're going to get into some of this in a second. But I think one of the things that's really important about that is it does create that regulatory permissioned structure to build on. This is now a solid thing that has a charter that's overseen directly by state and or federal regulators that you should feel comfortable as a developer building on top of. And even potentially, and this is a kind of an open question I have about the Genius Act and how it ends up getting implemented through regulation, potentially even giving you direct access to the types of things that only banks used to have, right? If you're a stablecoin issuer in the future, can you get direct access to a Fed master account? I know that's something they've been talking about. Can you issue cards directly on Visa and MasterCard's network without having to go through a bank? Historically, the answer has been hell no. If you're a regulated bank type thing under this new stablecoin framework, Visa and MasterCard would love to work with you, I'm sure. And so it starts to kind of knock out the reasons why you have to work with a bank and creates just infrastructure that is in some ways parallel to banks, which I think is really interesting.
Yeah. And I think that also underscores the reason why it's clear that why so many financial institutions and their lobbying organizations have put forth that, hey, we're
concerned about this.
Yeah, we're concerned about this. Yeah. And it's understandable why that would be the case. But
sure.
But I agree. I think that, one of the things that we are going to start seeing is that parallel maybe better, definitely different way of moving money. Not just moving money, but holding money, storing money, accounting for money, all of the fun stuff that we've been talking about for a very long time. But I think it does bring up some interesting things too that, we can't just say, back to what you were saying, we can't just say, oh, we're going to figure it out. We do need to make sure that we are figuring it out and figuring it out really, really well. Because there are going to be some issues where if this does grow as we think it's going to, and we start building on top of it, we start building important things on top of it, we do need to make sure that that foundation is absolutely solid. So, I am not one who's going to come along and say, oh, let's wild, wild west and the market will figure it out. I think we need to, it's this type of legislation, this type of regulation is obviously overdue. It should include some pretty explicit guidelines on what can and can't be done. And I don't think that we should, those of us who are fans of stablecoins or those of us who think it's an important part of what we're developing, I don't think we should necessarily push it away. I think we should actually say, yeah, nope, we need better referees. We shouldn't be complete wild, wild west again.
Well, let's double click into that because that has been a conversation recently on Twitter, in various WhatsApp groups. I feel like every corner of my phone I look at, there's someone sort of getting into a debate on some of those questions, right? And to put a little context around this, one of the reasons it's really important to get the legislation exactly right, in my opinion, is that we live in a world in which regulators are actually given less deference than they used to get from the courts in terms of how they write rules based on the laws that are passed, right? And so since the Supreme Court ruled on Loper Bright, the sort of law of the land now is that unless Congress sort of explicitly instructs you to do something in legislation, it's going to be much easier to challenge, right? And so legislation that's going to create regulatory rules like the stablecoin legislation needs to be, in my opinion, as prescriptive and specific and well thought out as possible, kind of covering all those different aspects that you mentioned, right? And to give a specific example that I think would be fun to kind of debate for a second, one of the conversations that's come up recently is how safe are stablecoins? Right. And that's a really interesting layered question to kind of pull apart because on the one hand, and I've said this multiple times, this is like the core feature of stablecoins. They're stable. They're backed one-to-one by incredibly safe assets. The way that the Genius Act and its sister legislation sort of define it, it can only be backed by really, really stable, safe liquid assets, right? Deposits held by banks, treasuries, overnight repos, like the safest of safe assets. Think sort of the equivalent to what's in a government money market fund. And government money market funds have historically never had any problems, right? Ones that hold corporate paper and other things that get a little more exotic have, much like there are some stable coins that have had more unique strategies for what they're backed by that have maybe had some problems. But the purest form of this idea is backed one-to-one by that very safe basket of assets that everyone agrees are rock solid. So in the one sense, stablecoin issuers and stablecoins, very, very safe, backed entirely by that, right? It's not fractional reserve banking. You're not taking risks with the money, very safe. The flip side to it that I found really interesting, and we published a piece through Fintech Takes written by Todd Phillips, who did a great job kind of pointing at some of the differences, I think, between bank deposits and stablecoins is because banks, going back to our earlier point, are risky and they do risky things and they lend money and they have a fractional reserve system. We've actually developed some pretty sophisticated and I think effective regulatory infrastructure that we've wrapped around bank deposits so that regardless of what banks do, deposit holders are in a relatively safe position. And, when you look at the Genius Act, there are some interesting parallels to how that works. So to give an example, when a bank is about to fail, there is the ability for the FDIC to step in and take that bank into receivership before it's insolvent, before it runs out of money. They'll typically do it on a Friday. And then they have a whole team that goes in and facilitates the sale of the bank and the transfer of the accounts to a new bank so that on Monday morning, when people go to check their accounts or use their debit cards, everything just kind of works. And then in the background, they sort of handle all of the paperwork and the disposition of the sale and the assets. And if there's any shortfalls or any problems, they have the insurance fund that can kind of plug those gaps. By contrast, my understanding of the current draft of the Genius Act is at a federal level, because it would be regulated by the OCC, there is actually no mechanism for federal regulators to step in and take receivership of a stablecoin issuer before it goes insolvent. Now, is that bad? Maybe in terms of possible interruptions to people's access to stablecoins. Again, stablecoin issuers are much less risky than banks, so the odds of them failing are a lot lower. Another example that I thought was fascinating that Todd brought up in his article was this idea that the way that the FDIC receivership process works, the FDIC actually is able to recoup its own costs for managing the estate and managing that process before even depositors get paid out. And that's typically the way bankruptcy works too, right? If you're going to declare bankruptcy, you have to be able to pay the trustee that sort of facilitates the bankruptcy process, and they have to get paid even before any other creditors. Interestingly, in the Genius Act, again, the current draft of it, it mandates that token holders get paid out first before anyone else, which is, I think, a great sentiment and is the right idea, but technically might create a problem because if a trustee needed to facilitate the bankruptcy of a stablecoin issuer, they actually wouldn't take on that job because they couldn't get paid first, and they have to get paid before anyone else does. And so, like, there's just these kind of little technical differences between the way I think that the legislation around stablecoins envisions some of these scenarios, like what happens if this fails or one of these issuers goes insolvent, and the way that we've kind of pressure tested how this system works on the bank deposit side. And so anyway, it's kind of resulted in this very fascinating conversation that I was referencing at the beginning of the podcast, where I kind of feel like stablecoin advocates and stablecoin skeptics, both operating from a place of good faith, are kind of talking past each other a little bit when it comes to questions around like safety. James, I know you've been observing and occasionally jumping into the discussion. What's been your take on that, like as an example of this sort of challenge?
One thing I will say, and this is one of the things that I had posted on last week, is one area where I do get a little annoyed is that it does seem like every time stablecoin advocates come forward with a solution to, hey, we're going to do this, that's not enough. They're not regulated. Okay, now we're going to regulate it. Yeah, well, they're not insured. Well, okay, what do you want from an insurance standpoint?
A moving of the goalposts.
Completely. And so that I find that when it's offered in bad faith, when somebody is just basically an anti-stablecoin person, I find that a little frustrating. Now, to the topic, though, of, well, what about if one does fail? Well, if one does fail and they are being backed one-to-one with something very, very liquid and something very, very secure, the asset still is there. They have not disappeared. As you said, it's very, very secure. So it's not as though it's going to disappear. The problem would then be, okay, how do we then make sure that the stablecoin holder that is made whole? And where I think that part of the issue to me is in the way the products themselves are going to be built. That is a risk. How do we price in risk? We price in risk with things like yield. So if you do have a concern that is going to be a problem, well, then the person who's issuing that stablecoin is probably going to have to offer you a little bit of yield. They're going to have to give you a reason to want to do that, to hold that stablecoin, as opposed to putting your money in a $250,000 limit FDIC insured account at a local bank. So those are the things that you're right. We need to make sure that these things are done very, very well. We need to make sure that they're very, very secure and that we know how it's going to be done. But that's going to be also incumbent upon the companies that are making these stablecoins available to do that as well, to make sure that they are compliant, but that they are also working with their consumers. And consumers need to be able to, consumers, businesses, companies, corporations, whoever is going to be buying these, market makers who are going to be holding these stablecoins, that they understand how that is going to be done in case there is any kind of a bankruptcy. But the point there still, to me, is it seems more secure than a fractional reserve. I mean, we were just going back and talking about, we need to allow banks to be doing some risky stuff. All right, let's go let them do some sketchy stuff. And yet over here on the other side, we're saying stablecoins are not going to be, those issuers can't do anything like that. They have to be backed one-to-one. It's going to be frankly, I think it's going to be a very tough business to be in. I think that, this idea that there's this gold.
Oh, we're going to talk about that. Yeah.
This gold rush in stablecoins, as we were talking before we recorded, this is not going to be a fun business. It's going can be very hard, very boring, and
It's kind of a utility in a lot of
yeah,
ways.
absolutely. That's just it. I look at stablecoins and I think this is not going to be that hot, sexy fintech company. This is going to be like providing electricity. This is going to be like providing, basically, is my cell service better than your cell service? It's cell service. I don't really buy based on that,
Right.
So that to me, I think is, as we begin to develop this and as that market is built out, I think it's going to be incumbent upon those companies that do the issuing to say, here is the way that we are doing it. We're doing it in a responsible manner, not just compliant, but also in a way that the market is going to say, yeah, absolutely, that's something that I want to. I want to put some money into those stable coins to earn a certain amount of yield based on the risk.
That makes sense. And, the being paid to take risks, like that's what depositors over 250 do, right? Like if you have a huge amount of money and you want to put it in a CD offered by a local bank that has a chance of failing, like you're taking a risk and you're being paid for that risk. And that's not unreasonable, right? I mean, uninsured depositors sometimes do lose money, right? It doesn't happen a ton, actually, interestingly, but it does happen. And, you're being paid to take that risk. So I think that's a fair point. I will say on the chance of failure versus the outcome of failure, I think that's a really interesting question, because the thing I kind of keep getting locking horns with stablecoin folks about a little bit is the beauty of the FDIC. And again, this is under 250. That's what we're talking about for this use case. And I get there's a whole other world for over 250. But under 250, the beautiful thing about the FDIC is it doesn't really matter what your bank is doing or how risky they're being or how much they're listening to their regulator or not. You're covered as a consumer regardless. Like you're getting your money back. And there's a 90-year history of that being 100% true. I think the thing that's interesting about stablecoins, by contrast, is the odds of failure are so much lower, right? They're so much lower. You're running a utility. You're literally just taking this, putting it here, giving this back. The odds of failure are lower. But unless the odds of failure are zero, and unless we only want really sophisticated counterparties using stablecoins, I do think it's at least worth thinking about how do you guarantee a safer outcome in the event that there is a failure? Because as we've seen with Synapse, as we saw with FTX and Voyager and a number of other examples, it's these disruptions to people having access to their money on Monday that really undermine trust more than anything else. And I think that is something that, hopefully they'll kind of work out in the amendment process. James, we're coming up on the end of time, so I want to be sensitive to that. But can we do lightning round with a couple quick questions?
Yeah, happy to. This is, okay. Yes, absolutely.
You're like a pig in slop right now. So
I'm enjoying this.
Okay, I'm glad. So one lightning round question is, you've said the word yield a few times.
Yeah.
The Genius Act doesn't allow technically for you to pay out yield. What's the argument for changing that and allowing stablecoin issuers to offer yield?
And the thing is, if you go back and listen to our last conversation, I even said I'm not totally comfortable about yield.
I remember that
about stablecoins, because yield is a sign of risk. That's how we price risk into something, and stablecoins should be absolutely, completely stable. That's the point of them. That said, they are going to be backed one-to-one with things that are offering a percentage. And so if somebody says, hey, I want to put my money in there, I think that taking yield out, taking that ability to earn yield, does strip out that signal that the market gets in how we price risk, how we price whether something is something we want to put our money into. And I think saying that you can't offer yield is taking that signal out. So it's not good for the consumer. It's also not good for the consumer because it does provide them with another account where they can earn some interest, which is a good thing for consumers, especially when you look at the other alternatives that are available to consumers through banks. I mean, high yield is now offering 3%?
Yeah.
Not the greatest. And so it gives them another financial product where they can put money in and earn interest, which is a good thing. So that's where I would say we would probably want to have that yield in there. That's where I also, though, think that we need to be really, really careful in saying that, hey, we want to promote yield as being the thing that would make you want to buy a stablecoin, because again, that's an indication of risk, and we don't want that.
Well, so it's interesting you say that, because there's two parts to the yield conversation that I find interesting. One is the ICBA objection, which is, hey, man, we need to be able to compete on savings accounts. And if you allow these things to offer yield, why the hell would you keep your money in a community bank or a big bank for that matter? So I think part of the objection to yield is you are going to accelerate deposit flight significantly if you allow these things to offer yield. And that is bad either if you have a cynical view, which is totally fair, that banks want to protect their existence and we shouldn't be passing laws to make it harder to be a bank.
Right.
Or if you want to have the less cynical view, which is what we were saying before about, no, we need deposits to sit at these institutions because they do lending and provide other socially useful services. I think it's kind of a mix of those two, to be totally fair.
I do too.
And so, I mean, like, I think that's fair in terms of that's one bucket of concerns with offering yield.
I mean, it does kind of remind me, though, of the carve out that the Postal Service had for anything that had been announced. You know, the other companies couldn't do that. They couldn't compete on that.
It's not that, right? I mean, like I think it's naive of anyone on the banking side of this debate to go, oh no, like, you know, the objections to yield are entirely based on a socially useful. We need to make sure we're continuing. Like, come on, like this would make these products vastly more competitive with not just operating accounts, but with savings accounts, CDs, like across the board, right? So like it is to a degree self-preservation. I completely agree. I think the other thing though that you touched on that I just want to push back on or maybe flip back around to you is a signal of risk. If the law requires that you only keep the money in certain ways and that is really well supervised and audited and transparent, and we know that the money is only being kept in these places and it's essentially being kept in a way that makes it like zero risk or the closest thing you can get to zero risk, what is the virtue of offering yield if by definition you're not allowed to take any risks as a stablecoin issuer? What risk are we pricing?
I think it would just be going back to what you were talking about, which what would be the process? There would still have to be a process. If for some reason that actually happened, there would still have to be a process for you to be made whole. So it wouldn't necessarily be automatic. And we don't know what that would be. Also, it's just a matter of saying, you know what, you are familiar with this, you may be unfamiliar with that. Therefore, we need to entice you to give that money in right now.
So like I know USDC, I don't know whatever this other. How many versions of acronyms, by the way, can we have that have U, S, and D?
I don't know.
Them?
That would be an entire podcast that we can do on just, can we please stop calling things tokens and can we please stop having acronyms that basically are all the same? So
okay, well let's we'll schedule that podcast for the future. I want to have that.
That would be the most boring podcast because you and me ranting about how bad they are for now.
Just naming criticism. That's a good one though. Okay, so that then ties into one other thing, which is I think the yield thing is actually really hard to police. And this is the thing I've noticed, right, is Coinbase offers yield rewards on holding USDC in Coinbase. PayPal, I think, and you'd be the one to
they don't call it yield, they call it a reward.
They call it a reward. Do they offer it now? I knew they were going to.
I believe it's 3.7% if you keep it in your PayPal wallet.
In your PayPal wallet. Okay. Right. So on PYUSD. So the reason I bring this up is it seems like even if the yield thing stays in it, it's going to be hard to sort of legislate and regulate because, oh no, that's a reward. That's not interest. That's a totally different thing. Or in the case of Coinbase, well, no, Circle's the one who issued the stablecoin. They're not offering yield. Now, ignore the fact that we have a huge equity stake in Circle and we have a distribution partnership where we make more money on USDC than Circle does. Like we're not breaking the law. We're just offering yield. So like there are ways around that. And the thing I want to tie this to, James, and I would like your take on is, we talked in our previous conversation about a Starbucks coin, a Disney coin. There's been pretty strong pushback from a number of different quarters on we want to keep commerce and banking separate. And so another sort of amendment that I've seen sort of people pushing for is we don't want big tech companies issuing stablecoins. We don't want to allow Walmart to issue a stablecoin. Is there anything to this like separation of commerce from payments and banking and kind of trying to keep that firewall intact? Or is that just like an antiquated concern from like 100 years ago that practically is not how we do things anymore anyway, and we should just let that go?
I think we just have to let it go because we're also looking at when you say commerce is separate from payments, well, commerce is the selling of something for money. So how do you separate that?
Well, and there's so many examples of companies on the commerce side doing payments, doing banking, doing lending. Like this exists today.
And part of this is we are building money that now is at that basic level of, it's now inherent to the internet. We will be able to build it into commerce and payments, and what can you do when you put those two things together? So even going back to the idea of, the carve out for postage stamps, you think about, well, we had to get around postage stamps because they kept raising the price and all we were doing was sending paper back and forth. And so now we have email, and think about what we can do now with all of the different ways that we've built commerce into that interchange of information that no longer requires a physical card to go somewhere. That's the type of stuff we're talking about. Is once we actually put the payment and the commerce together, and you have the ability, again, back to the idea of programmatic money that can think and can do all kinds of stuff. And I actually hate that phrase, the idea that money can think. It's not thinking. It's like calling it magic. It's not. There's a whole lot of stuff that's going to go into it.
Yeah.
But that's where I think we hamstring that development and the ability to do those things. And to your point, eventually, I think we will find ways around it. There will have to be ways around it. So if you know from the very beginning that people are going to find ways around it, that technology is going to find ways around it, then what's the point of having that rule in there? Just, does it make us feel better for a little bit of time? It's like, let's not even bother with that,
I will say the number of regulations and rules and laws that are passed strictly to make us feel better about a thing that's going to happen anyway, it's probably a pretty high number. So I think that actually is not unreasonable. But to your point, if we don't decide to draw that line, which I agree, like it'd be challenging to do, people would find a way around it anyway. It's kind of the default way the market works today. Tying back to yield, there's going to be no way to stop yield from creeping into these products because think about, we talked about it before, but like a Starbucks or a Disney or a Walmart, the number of levers they have to incentivize you to hold their sort of version of a dollar that they're issuing, they'd call it too many different things to be able to go, oh, that's yield, that's reward. Like it would multiply infinitely in ways that would make that hard to do. So I guess one of the things we're sort of discussing here is which things can you draw bright lines around and say, don't cross this line, and which things are just inherently going to be so hard. I'm thinking about the regulators, right? The poor regulators who have to write the rule. Like, we should all feel bad proactively for the people working at the OCC who are going to be handed this thing and go, okay, draft some rules on this, go through the Administrative Procedure Act, take comments from a very fired up industry about it, and then finalize rules. Like the rulemaking process is going to be hard enough as is. I think when you try to draw some of these like finer distinctions in the legislation, it's just going to make regulators' job that much harder and probably create more conflict with industry down the road, more lawsuits. Like there's going to be a whole sort of long tail to all of this effort that'll be interesting to watch. The last thing I want to ask you about, and it's something that you mentioned before, is this idea that stablecoin issuing is not a very good business. Because I actually been feeling the same way, right? Like it's kind of a utility. It's meant to be incredibly safe. It's meant to give stablecoin issuers like, here's a way you can make some profit. But, the ways that you typically, like if you take money from someone and hold it for them, traditionally the way you make money from that is go take risks and do things with that money that they won't do. And then you pay out the difference. If we're saying, hey, you're not allowed to go take risks doing that, that sort of naturally constrains the financial opportunity of being a stablecoin. So I've had the view, just based on the mechanics of how they work, particularly under the Genius Act, of there's going to be probably not as many stable coins as we think, because I do think it is a market that sort of gravitates to fewer more than like a lot, although some of the retail Starbucks, Walmart, Disney use cases we talked about do make sense. And that by itself, just as a standalone business, it's probably not going to be outrageously profitable in printing money. Now, I bring all of this up to say that I had that theory. I think you might have had that theory. And then we watched Circle debut on the public market. $27 billion
or whatever.
And it's like, oh my God, this is amazing.
Glad I had that idea. Yeah.
Yeah. It's like, and so I guess my question, James, is like, what the hell? Like, is my basic analysis of the mechanics of how stablecoins work wrong? Are public market investors really bullish on crypto and stablecoins specifically? Are they more just like, feed me any new public company and I will devour it because we haven't had IPOs in a while? Like, I know you've dug into it a little bit. What's your take on that?
First off, I want to write that down. I'm going to keep that the next time I moderate a panel. So my question is, what the hell? That's a great question. And
yes.
I think the answer is a bunch of those answers that you gave. Okay. So I do think that there is just a lot of people who are really excited about an IPO. I think there is that gold rush mentality around stablecoins. Finally, we can invest in stablecoins without buying stablecoins. We can invest in the entire market.
Yeah.
Where I think you're right, and I'm right, where we're both very smart and very right, is
thank you. This is my favorite part of the
podcast. Is the part where the moving of stablecoins, the issuing, the burning, the rules, all of that stuff will probably not be a great business to be in because it will be a utility. Well, I shouldn't say it's not a great business to be in. Utilities make lots of money and they do fine.
I'd love to be the CEO of a utility company.
Absolutely. Absolutely. So but in terms of, just wild numbers and margins and everything, it's going to be like utility. Where I think the opportunity is that idea of let's go back to the programmable money, but now programmable money across all these massive use cases that we think are going to be built. So the value add there being that community of developers that want to build on top of it, that bringing in an entire, ecosystem that is built around something. So if you go back to, even the discussion of Stripe with stablecoins and that, where I think that is a genuine competitor to a Circle. If they decide to get into the stablecoin businesses, they have that. They have it built in. They have an incredibly passionate, smart group of people within Stripe that are building out these developer communities. They have developers that want to develop on it. They've made it very, very simple. Now you throw in stablecoins and you have that value add built on top of that utility. So that's, I think, where there is a lot of excitement. Now, does Circle have that right now? I don't think so. They're building it out. That's something they're going to have to clearly build out. But now they have that distribution. They have that volume. They have people who are familiar with them, and now they have a lot of money that they can actually put into building that out. But that's where I think the excitement and the interest is not that stable coin, oh, it's money, it's digital money, oh, we're going to move it back and forth, and it's a utility. I think it's that building on top of those value-added services.
Got it.
Still, I do think the interesting thing there, to your point, is we still have a long way to go to see those value-added services built on top. So that, I think, is going to be the TBD part. What is going to be built? What is going to make it? Is it going to be money movement in developing markets? Well, a lot of developing markets where that's a good thing. Is it going to be those retail use cases we've discussed? Is it just going to be commercial payments? A whole lot of waste in commercial payments, a whole lot of expense. So those are things I think that is where we still need to see that being built out and having those developers come in and build those really cool things. And then the value add of having it built on top of that infrastructure and that utility.
Got it. So the analogy would almost be like, Visa Net is sort of a utility, right? Like it's relatively low margin, high transaction volume. It's kind of, it just works at kind of a baseline level. But over the years, we've seen Visa add Visa Direct, so they can cut out the issuers and you can build directly on Visa. They add fraud services. They add open banking through the Tink acquisition. So like they build more layers on top of their own stack, capture more of the value, and that's where more of the margin and the kind of attractive business is. Okay,
absolutely.
Yeah. That sounds right. And who knows? Maybe the investment bankers showed a crazy, amazing secret Circle roadmap to all the investors, and that's why they went crazy for the IPO. Maybe it's coming sooner than we think. I don't know. I was surprised, but also kind of happy in a way because I do think that it's good when. Say what you will about Circle and about stablecoins, whatever. I've offered plenty of, I think, hopefully reasonable critiques. It is, I think, by far the most we want to build a boring, safe, good business that people can build value on top of. And it makes me happy that the people who built in that way are seeing kind of the rewards of that work because it's been a long journey. So that's been heartening to say.
And there is probably a whole other discussion that we could have in future on those that are not doing that irritate me, within that very same space. So
yes, that'll be. It's funny you mentioned that because rhymes with Heather stablecoin issuer. It's so funny. No one ever will say their name whenever I'm at like a conference or on a panel or whatever, but they'll always like indirectly reference them. So we'll have to do that episode in the future. For now, I will let you go. James Wester, stablecoin correspondent for the Fintech Takes podcast at this point, I think. So really
I like
appreciate
that. I'll take that. I'll take that.
Okay. All right. Well, I appreciate it. We'll have you back on again soon.
Anytime. Thanks, man.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.